I want to talk about how to diversify your tax strategy. A lot of people that have come to us over the years, we've noticed that they come with one bucket of money that is all, for example, IRA. And now when they retire, or if they're already retired, they're taking income on every piece of income that they're receiving is taxable. And they have no control or little control over what their tax bracket is if they want to take an income stream. So the sooner you can start doing proactive tax planning to determine which buckets you're going to pull money from in retirement, and as you need money, perhaps even before retirement, the more money you'll save, this can account for 1/3 of the total income that you'll take in retirement. So for example, if you have some buckets of money that are entirely tax-free, and that's 1/3 of your portfolio, and you have another 1/3 of your portfolio that you're paying taxes along the way, capital gains taxes, maybe you've got dividend type investments that you're paying taxes on just a 15% tax bracket today. And then you've got another bucket of money over here where it's going to be taxed later. So we've got our taxed never investments, which might be your life insurance cash value, your Roth IRAs, your tax-free IRAs. We've got our taxable bucket where we're paying taxes along the way. These might be a brokerage account. And then we've got our taxed later bucket, which means that we're deferring the taxes. We're putting money in pre-tax and planning on taking income in the future and paying taxes in the future. Well, what happens invariably is that you're going to be in a different tax bracket along the years. Some years, you may have a capital gain where you sell a business or a property or another investment that puts you into a higher tax bracket. You may have a high income year. You may have a low income year. Or in retirement, there may be Social Security taxes that you want to lower. And so depending on which income you're drawing income from will dictate what your taxable income is. When you're diversified by tax bucket, you're able to control what your taxable income is. So any given year, if you're in a high bracket, you can subsidize your income that year from your tax-free bucket. When you're in a low income year, you might subsidize your income that year from your tax deferred bucket. Or if you don't need that income in a given year, but you are in a low tax bracket, you might convert some of your tax deferred money into tax-free money. Do, for example, a Roth IRA conversion. And when you do that, you're paying very little on the taxes because you might be in a year where the business had a realized loss or had some loss carry forward that it was able to utilize towards that conversion to allow you to, in essence, move money from a taxable bucket to a tax-free bucket for maybe 10 or 20 cents on the dollar, when you know in the future you might be able to, you might be paying 40 or 45% taxes. We also can assume that tax brackets in our country may go up in the future. And so as that happens, and that changes from one administration to another, you have put yourself into a position where you can respond depending on what those tax brackets are in the country. So as you look at your overall diversified strategy, don't just diversify by asset class, stocks, bonds, real estate, commodities, things like that. Diversify by type of asset that you're invested in and how it is taxed. Make projections. Project what the assets in the tax-free bucket are going to grow by over 20 years or when you expect that you will need to be able to pull that money out. Make projections on what your tax-deferred bucket will grow by based upon what it's invested in, based upon the historical performance, based upon the outlook going forward. And when you model that out on a spreadsheet, then you can determine what your adjusted gross income could potentially be and what the taxes on that would be, so that now you realize how much money you are putting in your pocket in retirement or when you need that money. At the end of the day, it's not the gross amount that you're able to pull off your portfolio, it's how much you're able to take from your portfolio and put into your pocket for consumption. So that exercise will allow you to control and predict what that income is going to look like net in your pocket.